A very good afternoon, everyone, and welcome to Deloitte's Debriefs Tax Webcast series in Asia Pacific. Our webcast today is from our Corporate Income Tax and Bold Play series and is titled M&A and COVID-19 Strategy in Indonesia, Malaysia, Singapore, and Thailand, Charting New Horizons in a World of Asymmetric Recovery. Now, my name is Kwang Gek, and I am a tax partner based in Deloitte Malaysia, Kuala Lumpur office. I have the pleasure of hosting today's webcast. I have four speakers with me today, as you can see from the screen, Chai Sok Peng, John Lawrence, Anthony Loh, and Jeff. Sok Peng is a tax partner based in Deloitte Singapore office. John is a tax partner based in Deloitte Indonesia Jakarta office. Anthony is a tax partner based in Deloitte Thailand Bangkok office, and Jeff is a financial services M&A leader in the Southeast Asia based in our Deloitte Singapore office. You may access our bios on the left side of the screen. Now, before I introduce the agenda for today's webcast, I would like to take a moment to highlight some of the features of our webcast console. Firstly, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Secondly, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. All right, now let me give you an overview of the topics we will be discussing today. Firstly, we will be running through M&A, general trends and environment. That will be covered by Jeff, and then followed by tax perspectives on M&A and COVID-19 strategies in Indonesia, Malaysia, Singapore, and Thailand. And last but not least, we'll have a Q&A session. With that, I will hand over to Jeff, who will take you through M&A general trends and environment. Jeff, over to you.
Well, thank you, Kwang. Good afternoon, everybody. Thank you for taking the time today to participate in this webcast. I'd like to take the first 10 minutes or so of the webcast to frame what's happened in M&A market, what the current state is presently, and what to expect in the near future. We certainly are living in unusual times, and M&A has not been spared the effects of the pandemic. It's clear that activity all but dried up at the end of the first quarter of 2020. With the benefit of hindsight, we had reached the end of an M&A cycle, and we collectively paused at that time to reflect on what had just happened, its impact, and what to do next. In practical terms, that meant almost all transactions went on pause, and in time, a large proportion were abandoned. We back up that point of view in two ways. Firstly, with a survey we undertook recently in the US, you'll see from the slide on the left-hand side that the vast majority of the respondents to the survey both paused and abandoned deals. It's striking that 92% said they paused transactions and 72% said they abandoned deals. Taking that one step further to read the tea leaves, it's also clear that large percentages of those respondents both delayed and abandoned what must be a large part of their pipeline, being 3 deals or more. Secondly, to back up that point of view, we look closer to home. We can point to a drop-off in deal completions in Southeast Asia. On this slide, we compare 2 full calendar years, 2018 and 2019, and a 9-month period, year-to-date, to September for 2020. The data shows 3 things. First of all, a peak in volumes in 2018. Secondly, a peak in values in 2019. And thirdly, a drop in both in 2020. The last quarter of 2020 is unlikely to hit the run rate of the first 9 months. So if we are speculating as to a best estimate of activity for the year, we guess that it will be a reduction in volumes of between 15 and 25%. That'll translate into about 250 to 295 deals in Southeast Asia, worth somewhere between $60 and $65 billion. It's helpful to break that overall position down into a sector-based view. It's clear from the charts that you can see that the negative impact from COVID has been across the board. Few, if any, sectors have been spared. Some, of course, have been hit harder than others. To call out the key messages here, deal volumes have been hit hardest in consumer business and in financial services. Deal values have been hardest hit in energy resources, life sciences, and healthcare. There have been some bright spots, specifically TMT in Asia and financial services in Europe. Bringing the sector view closer to home, we see a similar picture. Both volumes and values down in 2020 relative to 2019 and earlier. The exception, the area where there has been asymmetry, has been specifically in consumer business in Southeast Asia, which has shown more resilience in both volumes and values than has happened elsewhere. It's also helpful to take a country view for Southeast Asia because, these are separate markets and they do have different characteristics. The consistent picture that we see across Singapore, Thailand, and Indonesia has been that deal values have held up from 2018 through to 2019, only to drop both in volume and in value terms in 2020. In each case, value has dropped proportionately more than volume, more so in Indonesia and Thailand than in Singapore. That said, the standout story, and unfortunately it's from a downside standpoint, has been Malaysia, where we've seen volumes down 40% across the period, but values down an incredible 88% over the 33 months. Only $1.25 billion transacted in M&A in Malaysia in the last 9 months. Tough times indeed. That's all well and good as to the picture of the immediate past and the current state. What's probably more important for us all, though, is what the future will look like for M&A in the near term in Southeast Asia. We do like to take an optimistic view, and we do have some positives to report. I'd like to give 3 key messages to the group. First of all, there is clear evidence of green shoots of recovery, or emerging from quarantine, as you'll see from the slide, in M&A markets. The slide shows a month-by-month view of deals closing in the US. The picture that is there is one of a downtrend in the first half with a fairly strong recovery in the third quarter. We have not seen evidence of exactly that type in Southeast Asia, but anecdotally, across our firm, we have seen resurgence in the initial phases of M&A processes. So clients who are planning, preparing, starting initial approaches and beginning to negotiate. If that's true, and it is applied more widely in the markets, that will be consistent with past experience. Generally, Southeast Asia lags the bigger and more mature M&A markets by something between 2 and 4 quarters. Secondly, it's becoming clearer that in this cycle, there will be differences. I want to focus you on the left-hand side of the chart here. There will be a greater variety of deal types. What exactly does that mean? It means that there will be more and probably a higher proportion of strategic investments, alliances, and long-term contractual arrangements, in addition to more traditional M&A. The left-hand side, if you look at the green bars there, you'll see that the output from the survey shows in the US that 45% of the respondents were looking at alternatives, in addition to the 35% that were looking at traditional M&A. We see a very similar picture when we're consulting with clients across Southeast Asia. Thirdly, we see all the makings of an active M&A market going forward. Again, the survey is helpful. If you look on the right-hand side at the outer circle, what the Americans describe is there is a greater proportion of what they refer to as attackers than defenders. In Southeast Asia, what I would really take from that is that there remains plenty of buy-side interest in targets in this region, and as importantly, plenty of capital to back up that interest. To me, that signals an M&A market with some depth, and one that is not going to be marked by stress and distress. That is, meaning stress and distress, will happen, but do expect that it's going to be an exception and not the rule. The inner part of the circle shows a fairly even split of motivations and approaches. We do see clients seeking to rationalize their footprint across Southeast Asia. We do see clients looking to build position across the region. And we do see clients responding to disruption and to new entrants by acquiring, investing, and forming alliances. Those elements are exactly what we need for a vibrant M&A market. If put on the spot and asked as to how the immediate future will look, we'd expect a gradual recovery in volumes and values in the first half of 2021, with bigger transacted volumes and values in the second half of 2021 and through to the full year in 2022. I trust this has been helpful in setting the scene for the discussion this afternoon. We'll be happy to take your question. For now, I'd like to hand you over to John, who will speak about Indonesia. Over to you, John.
Thank you, Jeff, and good afternoon to our viewers. So I think just aligned with what Jeff mentioned as an overview, that's pretty much what we see exactly in Indonesia. So up until the first quarter of 2020, well, basically a lot of those deals actually be delayed, if not abandoned. And secondly, of course, but on the right side, we start to see a couple of those deals actually start to pick up in the past few months. So some of the sectors, as also aligned with what Jeff has shown before, is the infrastructure, consumers, technology, telco, as well as the e-commerce. There's an increased trend in carving out of the non-core business, dominantly through a share deal, of course. and a couple of them, of course, on a smaller volume, structured as an asset or business deal. Aside from the external deal, we also see an increase of internal restructuring through merger. Of course, in this case, to increase the efficiency, and we've seen that particularly a lot in the consumer as well as the manufacturing sectors. I will discuss further about the tax consideration of the share deal and asset acquisition as well as the merger in the later part of my presentation. From the government perspective, there were several new policies, fiscal policies specifically, introduced during the pandemic, largely to prevent further slowdown of the economy, as well as to promote investment and provide more certainty to the business environment. So the first one, perhaps you already heard that Indonesia already reduced the corporate income tax rate from previously 25% to now 22%. For the next 2 years until 2021, and further to 20% starting from 2022. This is, of course, a positive move by the government because originally the new rate was supposed to be introduced or effective from 2021. Secondly, is the introduction of the Omnibus Law. This law practically changed a lot of the tax laws and also non-tax laws. So the key changes in the taxation impacting the structure, among others, as mentioned in the slide there. The first one is on the dividend. If an Indonesian company receives a dividend from another Indonesian company, previously there was an exemption, but only if the ownership actually is minimum 25%, and the distribution is coming from the retained earnings. But now with this Omnibus Law, actually both of those conditions have been eliminated, meaning that even though the ownership is less than 25%, still the Indonesian parent company will still be able to enjoy the tax exemption. Now on this slide, actually the next changes are relevant to the bond investment. Previously, any income received from abroad is subject to tax because Indonesia adopts the worldwide taxation basis. But with this Omnibus Law, if it is a dividend, business income received from abroad, either through PE or non-PE, would eventually be tax exempt if certain conditions are satisfied. And those are the conditions include, first of all, at least 30% of the profit will need to be invested in Indonesia. Of course, at this stage, we are still waiting for further guidance on detailed conditions of the investment rule. Next is the possibility that the current interest withholding tax may be reduced under the government regulation. So right now it is 20%. But of course, at this stage, it is not clear whether the reduction of the interest withholding tax will be available to all foreign loans or only to for the government loans. Lastly, the in-kind capital injection. So, for example, a parent company injecting asset as opposed to cash into a new subsidiary or existing subsidiary. There will be a VAT exemption facility so long as the both shareholder as well as subsidiary are registered. So moving on to the next slide. So first one on the share deal. I will discuss about the tax consideration. Typical what you probably expect from a share deal is that the exit could occur by selling the shares of the Indonesian target, or in this slide actually the Indoco, or what we usually call it as a direct sell. Or secondly, you might also sell the shares of the company outside of Indonesia, which hold the shares of the Indonesian market, or what we call a direct sell. For the vendor, principally, if it is a direct sell, there will be an effective tax rate of 5% imposed on the gross consideration of that deal. Now, there might be a treaty relief depending on the jurisdiction of the holdco in this case. But again, please be reminded that Indonesia applies certain conditions for any foreigner who wish to apply for the treaty relief. In the case of indirect sell, similarly, there's a 5% tax imposed on such transaction, but only if the holdco is located in the tax haven country. And secondly, even if somehow Tolko is qualified as a tax haven country, there's still a possibility to seek for relief under the applicable treaty. Now, from the buyer perspective, as a normal M&A process, a due diligence is needed really to assess the historical tax exposure of target and, of course, for negotiation purpose with the vendor. The buyer will also like to ensure that the buyer entity or holdco will be able to satisfy the Indonesia substance requirement, particularly with respect to the future repatriations such as dividend or interest. Now, on the next slide, it's what we describe here actually is an asset deal, basically, where Indoco actually will be transferred some part of the entire part of the asset to another company in Indonesia. In this asset deal, from the vendor perspective, or Indonesia Co actually, the capital gain on transferring non-property asset will be subject to the ordinary tax regime. If the asset is property, land and building, then the transfer will be subject to final tax of 2.5% on the transaction value. Subject to pre-approval from tax authority, actually there's a possibility to enjoy a neutral or book value spin-off, for example, but that facility is available in certain conditions. For example, if the transfer or spin-off actually for IPO purpose to establish the Sharia business unit, or if the new co will be receiving investment or injection from the foreign investor for a minimum of 500 billion. And as well as the last one, which if there will be a participation from the state for establishment of the state-owned enterprise holding company. If this approval can be obtained from the tax authority, then of course, ideally, there will be no income tax on the spin-off. From the VAT perspective, the transfer of asset would naturally subject to VAT. Now, on the next slide is from the perspective of the buyer, basically. So for the buyer, when you acquire the asset, then basically they will step up to the depreciation. So gradually the acquisition value, if it is a fixed asset, you can claim it back as a deduction for tax purpose. And compared to share deal, of course, the asset deal, in the asset deal, the buyer will not assume any historical tax risks or attributes of the seller or the local in this case. On the property, if there will be a acquisition of property, land and building again, it will be subject to 5% acquisition duty, and the value will be based on the transaction value or the deemed market value as assessed by the regional authority for land and building tax purpose. Now, if the new goal to acquire this asset actually get financed from internally or from outside externally, then basically, principally the interest on that for that one actually can be claimed as deductible. But of course, you need to observe the application of thin capital in Indonesia, which is currently 4:1, unless of course if the business of Newco is falls within the list of industry which is exempted from this application of thin capital. In the case of 10% VAT is paid, then the buyer of course may be able to claim input of the VAT as a VAT credit, on the condition that its business going forward is also subject to VAT. Now, on the last structure, basically, we are talking about the tax consideration of a budget, which I think is pretty much similar to an asset deal, except that, of course, the key difference is if it is a merger, then there's a transfer of asset and business, then it will be clearly VAT exempt. On the basis that, of course, the buyer and that both companies merged actually are registered for VAT. Now, for income tax purpose, there is also possibility, of course, to obtain tax neutral or book value merger facility. But of course, this is subject that I need to be carefully considered, because what happens is the approval process can only be executed after the merger has been completed. Now, on the 5% acquisition duty on property, there might be also a possibility of getting a reduction if the merger actually can be able to obtain the tax neutral merger facility from the tax authority. Now, on the last part, of course, when after the merger, naturally, for tax purpose, Indoco 1 will need to be registered from the tax authority administration, and that will trigger an audit. So there will need to be a planning, of course, look at the profile of the former Indoco 1 to make sure that actually the shareholder are comfortable with the position prior to going to the registration process. And lastly, a merger is a complex corporate action, so I think please be reminded that actually there will be a lot of employment issue as well as regulatory restriction, which also need to be evaluated or observed in implementing any merger. So I think with that, I will hand over to Kwang Wei. Okay.
All right, thanks, John. So I will cover the Malaysia perspectives. So currently, there are no specific exemptions or incentives for M&A transactions undertaken during the COVID-19, except for certain stamp duty exemptions available for M&A exercise undertaken by the small and medium enterprises in Malaysia. So some of the common M&A transactions happening in Malaysia are sale of non-core business for cash-trapped companies, seller looking to restructure internally to carve out certain business before the buyer agrees to buy the business. And for those who are seeking to expand and grow market share, the M&A transactions are what I see is largely in the technology, healthcare, and manufacturing sector. So the deal structures in Malaysia can be broadly divided into two types: acquisition of business or acquisition of shares. And for the purpose of today's debrief, I will discuss the Malaysian tax issues relating to both types of acquisitions. So now this slide is on acquisition of assets or business acquisition. So this is a typical case during COVID-19 where companies face cash constraints, and then they decide to carve out non-core assets to generate cash flow. The cash flow can then be used to sustain the core business in the group. So here you see a third-party buyer that will be acquiring the business from Sub B, all right, from Sub B, which is Sub B is the one holding the non-core business. So from an income tax perspective, the tax treatment on the transfer of tax depreciable fixed assets would depend on the relationship between the buyer and seller. And in this case, since this is a third-party transfer, then the difference between the sale proceeds and the tax written down value would be taxable or allowable for the seller. For the buyer, then they claim initial and annual allowance based on the values of the assets acquired. Now, when it comes to transfer of stocks, the value of the stocks transferred would be deemed as value of stocks for the buyer as long as the seller has permanently ceased its business and the buyer uses the transferred stocks in its business. All right. Next, when it comes to transfer of receivables, it will not be deductible for the buyer if the debt turns bad in the future. So it is very important for the buyer to assess the recoverability of the receivables before acquiring them. Now, in terms of unutilized tax losses, or capital allowances, these cannot be transferred to the buyer, and these balances will remain in Sub B. Yeah, in this company, in this example here, it will remain in Sub B. For stamp duty, the transfer of property will be subject to ad valorem stamp duty of 1 to 4%. And the meaning of property here includes things like land and building, contracts, receivables, as well as goodwill. In terms of real property gains tax, RPGT for short, this is only applicable for disposal of real property or shares in RPCs, where the gain arising from the disposal therefrom will be subject to RPGT. The RPGT rate is 30% to 5%, depending on the period of ownership and profile of the disposer. You can see that in the table next page afterwards. Now for the buyer, then it is very important here that the buyer must remember to retain an amount. And what is the amount here? The amount is the entire amount of money consideration, or 3% or 7% of total consideration, whichever is the lower. And then the buyer need to remit that amount to the Malaysian Inland Revenue Board. If the buyer forgets to do so, there is going to be a 10% penalty on the amount that should have been withheld by the buyer. From an indirect tax perspective, then, approval from the Malaysian customs authorities is required if the assets transferred were exempt from sales tax or import duty when acquired previously. All right, the next slide here. This is a table that shows you the rates of RPGT depending on the profile of the seller and the period of ownership. So for example, if the seller is a company not incorporated in Malaysia or a non-citizen, non-PR, then you can see that the RPGT rates are higher for disposals made within 3 to 5 years. Okay, next I will discuss broadly on share acquisition. So in Malaysia, there may be some restriction on the carry forward of unutilized tax losses or capital allowance in a company if there is a substantial change in the shareholding of the company, meaning more than 50%, and if the company is dormant. So in this example, the unutilized tax losses or capital allowances can continue to be carried forward as long as sub B is not dormant at the time the share transfer takes place. And one important consideration when it comes to buying companies with tax losses is to ensure that the transaction is not tax-driven, but undertaken with commercial considerations in mind. Otherwise, the Malaysian tax authorities may invoke the general anti-avoidance provision and disregard the tax losses. Do also take note that there is now a 7-year limit on the carry forward of tax losses. Now, from stamp duty perspective, the transfer of shares of a private limited company is subject to stamp duty at 0.3% on the value of the shares. And the valuation of shares here is based on the higher of the net tangible asset or consideration for the shares. Now, whether or not real property gains tax applies, it will depend on whether sub B is regarded as a real property company. So disposal of real property company is subject to RPGT, and the rates are 30% to 5% depending on the holding period and the profile of the disposer. Now, what is an RPC? So briefly, an RPC is a company that owns real property or RPC shares, and the market value of which is at least 75% of the value of the total tangible assets at that time. Okay. Now, next, this structure here is another common restructuring taking place during COVID-19, where there's a merger of businesses within companies in the group to mitigate overall operational costs by, for example, cutting redundant operations and improving overall efficiency. So the tax considerations in this case are very much similar to an asset acquisition scenario discussed earlier, except that when it comes to transfer of tax depreciable assets, then controlled transfer provisions would kick in. This would mean that the buyer and seller are within the same group, and therefore it will give rise to a no gain, no loss situation, meaning that the buyer continues to claim annual allowance on the assets, but subject to the tax written down value of the assets acquired. From a RPGT and stamp duty perspective, there are exemptions available in Malaysia but these are subject to meeting conditions stated for such exemptions. So this wraps up the Malaysian tax considerations. I will now hand over to Sok Ping to discuss the Singapore perspectives. Sok Ping, over to you.
Thank you, Kuang Kek. Right, in Singapore, as mentioned by Jeff, we see the volume and value of deals have decreased as a result of the pandemic. We also observe certain trends in the pre-COVID-19 world have accelerated. For instance, more focus on cost reduction and more efforts around conserving cash in many businesses. So in Singapore, other than several tax measures introduced by the governments to help companies with liquidity and payroll rental expenses, there are no particular new changes to the tax rule itself that is specifically relevant to M&A. However, because of how businesses are moving and the risk appetite of the deal makers given the current uncertain economic environment, there may be preference over certain deal structure, which I will touch on briefly and talk about the relevant consideration from Singapore tax perspective. So in this deck, we have summarized very broadly some of the common tax consideration for M&A in share and asset deals. I will not go through all the points, but will select a couple of points that may be more relevant in the current environment. So now let me probably start off by sharing with you some practical consideration in a share deal transaction. We sometimes see a pre-sale internal restructuring being carried out by the seller. Depending on how the deal is going to be structured and what is within the target business, the seller, or sometimes at the request of the buyer, may carve out certain business or asset from the deal. And for instance, for targets who own property, one common arrangement that we see is that the sales and leaseback may be structured. And also, if there are other business or investment within the target that has very little relevance to the key business as a whole, a carve-out of that business may be considered just to make the deal more attractive. So we may see this pre-sale carve-out exercise more because the buyer may be more selective in terms of what they buy during the uncertain time. So with the pre-sale carve-out, one consideration is really to understand the tax implication that could potentially impact the target, the seller, and the buyer. For example, whether there'll be any risk of being deemed a gain or higher gain to the target, given that this is going to be a related party transaction, and what are the transaction costs as a result of the carve-out and so forth. So in short, from the seller's perspective, it has to make sure that the pre-sale carve-out is executed tax efficiently. And from the buyer's perspective, it will want to get comfort that he's not inheriting any tax risk arising from this exercise that could potentially sit within the target. The other relevant consideration to the seller in a share deal transaction is around the tax treatment on the disposal gain and how the gain is to be computed and treated for tax purposes. With the COVID-19 situation, an earn-out structure may become more attractive during the pandemic and preferred by the buyer to a certain extent. The practical advantages to the buyer is really, it reduces the risk of overpaying for the target business and essentially deferring part of the consideration to the later date, conditioned upon the target performing as forecast by the seller. This can be very important for M&A transaction at a time when it is not clear how long the direct and indirect economic effect of the COVID-19 pandemic will persist. So typically under the earn-out structure, the seller will remain involved in managing the operations of the target business to help achieving the revenue-based target. One potential tax consideration around this earn-out structure is the characterization of the earn-out itself and the tax treatment depending on how the earn-out is being structured. For example, whether that can be taken as a payment for the services rendered by the seller in managing the business post-closing, or it is part of the purchase consideration for the shareholding interest in the target. So if the earn-out is considered as part of the purchase consideration, there may be less of a concern for the seller if it qualifies for tax exemption under the safe harbor rules, or if the gain is clearly capital in nature. Briefly, in Singapore, we do not have capital gain tax, unlike many other countries, and therefore any gain from the share disposal will only be subject to tax in Singapore if it does not qualify for the safe harbor exemption and it is a revenue gain that is sourced from Singapore. Likewise, in the case where the disposal is made on the distressed business at the loss will not be allowed to shelter the income tax of the seller under the same scenario. On the other hand, in cases where the gain may be subject to tax in Singapore, computation of the disposal gain and the taxing point under the earn-out structure may need to be considered carefully. As from the buyer's perspective, what is needed to be looked at under the earn-out structure is the implications around the stamp duty. In Singapore, stamp duty on the transfer of shares in a Singapore company is to be borne by the buyer unless it is commercially agreed otherwise by both parties. The formula used to compute the stamp duty is 2% of the actual consideration paid and the fair market value of the shares, whichever is higher. So for unlisted share, the net asset value may be used as a proxy for the fair market value for stamp duty purposes. So the stamp duty calculation may become a little tricky under the earn-out structure, as in what amount should be used for computing the stamp duty, whether we can arrange for the future earn-out to be up-stamped 1 or 2 years later when the amount can be ascertained, and whether there is any risk of being subjected to late filing penalty and so forth. On the other hand, if the earn-out is to be structured as a service fee payment, the tax implication for both the seller and the buyer will be different, and tax analysis will need to be performed to ascertain the tax treatment, which would very much depend on the facts and circumstances and many other factors, as well as the wording in the SPA. It is therefore important to involve the tax advisors when negotiating the terms of the deal if the earn-out structure is to be considered, just to make sure that the wording in the SPA is crafted appropriately and the tax consequences are being taken care of. Another arrangement that may be getting more common is that because of the focus on the cost reduction, as I mentioned right from the start, as also pointed out by Kwang Kit, some buyer may be looking to acquiring the target business followed by a merger into its own existing business, as opposed to operate the target business on a standalone basis, more to make sure that there's no duplicate functions within the group and to manage the operation cost as a whole more efficiently. This is typically done through an asset deal arrangement as a start, but in the situation where the seller prefers or insists a share deal transaction, the merger plan may be structured through an amalgamation subsequent to the share deal. In Singapore, we have a tax framework for qualifying amalgamation, which is introduced to facilitate merger and corporate amalgamations in Singapore and to align the tax treatment with the treatment under the Companies and Banking Acts. The aim is to really minimize the tax consequences arising from the amalgamation. The tax framework essentially gives tax effect to qualifying amalgamation as if there is no cessation of existing businesses by the amalgamating company, and therefore no acquisition of the new businesses by the amalgamated company. And all risks and benefits that exist prior to the merger are transferred and vested in the amalgamated company. In other words, qualifying amalgamation will be treated as a continuation of the existing businesses of the amalgamating company by the amalgamated company. This tax framework essentially provides a tax-neutral effect, and one key benefit under this tax framework is that it also allows any unutilized tax losses in the amalgamating company to be taken over by the amalgamated company to shelter the future taxable profit. However, in the situation where the amalgamating company has obtained certain grant on the capital assets from the government agency, we should be mindful of whether the amalgamation could lead to any breach of the standard conditions for the grant, and the timely conversation with the relevant government agency to confirm the position or to request for a waiver of the requirement will be important. In short, there are administrative procedures to be followed in order to apply this tax framework for qualifying corporate amalgamation. And therefore, if the amalgamation plan is to be considered, it will be key to talk to your tax advisor to understand the condition, the procedure, and the timeline for the election and so forth. So that's pretty much I want to cover from Singapore, and I will now hand it over to Anthony to talk about Thailand. Anthony, over to you.
Okay, thank you, Sopeng. Hi, everyone. I was often asked, why should taxation be considered for M&A in Thailand? And my typical, response are like, number one, to identify potential tax liabilities which could impact pricing. And to identify the most tax efficient way to structure a deal, whether it's asset deal or a share deal. And to structure, the M&A documents from a contractual terms relating to taxation before you finalize it. And, the last one that I can think of is generally to identify post-merger integrations, cost savings, or cash optimizations opportunities through some form of tax management, restructurings, or improvement. Thailand probably manages the pandemic a little bit better than the neighboring countries in Southeast Asia. This, however, comes at a cost. Since Thailand's GDP heavily relies on hospitality sectors, the restrictions of allowing people to enter the kingdoms has caused significant impacts to businesses. So we are seeing companies looking to increase cash flows by consolidating business or legal entities to reduce costs and to seek strategic partners for additional equities, expertise, and market access. Now, common methods for M&A in Thailand is not too dissimilar to what you have already heard for other countries. Share deals, asset deals, and Sopeng mentioned just now amalgamations. Share deals have, in Thailand, have 4 common scenarios. The first one, buyer and sellers are overseas while the target is in Thailand. And typical tax considerations would include a capital gain from the seller jurisdictions, withholding tax from the buyer jurisdictions. And just to note that the buyer and the seller could be in the same or different jurisdictions. Stamp duty, when updating the shareholder list in Thailand. And share deal would allow preservations of tax losses, if any, in target. Bear in mind, when we do share deal, there could always be historical tax liability considerations. The second scenario is where a buyer is overseas, while sellers and targets are in Thailand. Typical considerations, capital gain from the seller side, which in this case is in Thailand, at the rate of 20% if the seller is a company, or progressive rate of 5 to 35% if the seller is an individual. There could be withholding tax from the buyer side, although it could be protected by treaty. There will be stamp duty when updating the shareholder list in Thailand. Preservations of tax losses, if any, in target is allowed. But of course, historical tax liability considerations, it's there. The third scenario is where buyer and targets are in Thailand, while sellers overseas. And considerations would generally include capital gain from the seller's jurisdictions, which is outside of Thailand in this case, depending on which country that may be. Withholding tax from the buyer jurisdiction, which in this case is in Thailand, although it may be protected by a tax treaty. Stamp duty when updating shareholders list in Thailand. Preservations of tax losses is allowed, but there could be historical tax liability, considerations. The last scenario is where buyers and sellers are overseas and target is in Thailand via an indirect transfer, meaning there's intermediary in between. So the typical tax considerations would be capital gain from the seller's jurisdictions, withholding tax from the buyer jurisdictions. And again, just to note, the buyer and seller could be in the same or different countries. Preservations of tax loss in target is allowed. And there would be historical tax liability considerations. Now, the other way to structure a deal in Thailand is via asset deal. Asset deal in Thailand generally involve in the sellings of business or assets from one company to another. So the typical implications for an asset deal is we have 20% corporate income tax on the gain. There's 7% value-added tax on the valuable business. 3.3% specific business tax on transfer of immovable properties. There's a 2% transfer fee on transfer of immovable property. So you heard that right. It's 5.3% altogether, even though they are paid to different authorities. There's a step-up cost is allowed. Tax losses, if any, would remain with the transferor, which in this case is Company A. There are legal considerations, especially, the question is whether Company B has the proper business license to operate the acquired business. However, under the Thai law itself, there are certain incentives to encourage entire business transfer, which is also known as EBT, whereby the Company A, being the transferor, must sell the business at market value. But any gains are exempt from corporate income tax. Value-added tax, specific business tax, and stamp duty are exempt under this EBT scheme. Tax losses, if any, would remain in Company A. However, there are conditions that needs to be complied in order to be availed with this benefit. Company B, the first one is Company B, being the transferee, is not allowed to step up the acquisition cost. Company A must be dissolved and liquidated in the same accounting year. And there are other legal considerations as well. Incentives are also granted to partial business transfer, or also known as the PBT, whereby Company A, being the transferor, must sell at market value. Any gain would be subject to 20% corporate income tax. VAT, specific business tax, stamp duty, however, are exempt. Tax losses, if any, would remain at Company A. Unlike EBT, however, Company B, being the transferee, is allowed to step up the cost since it doesn't enjoy corporate income tax exemptions on the gain from the transfer. Company A is not required to be dissolved and liquidated. And there are legal considerations similar to EBT. Amalgamations, as Shuk Peng mentioned earlier, is actually a concept of two legal entity integrated where there are continuity of business. So in the normal situation, the way I would explain is using this example is Company A and Company 2 integrate to form a new company, and whereby Company A and Company 2 dissolve under the law. But the business in Company A and Company 2, would continue in the new entity. The integrations must be done at the market value, but corporate income tax, value-added tax, specific business tax, and stamp duty are exempt. Transfer fee on the transfer of immovable properties are also exempt. Tax losses, if any, are forfeited, unfortunately. There are legal considerations. Amalgamation is suitable for land-rich businesses. Just very quickly, let's look at the typical investment funding in Thailand. The common funding structure in Thailand is really the equity funding versus debt funding. Equity funding, it has either no or minimum tax cost. And what that means basically is the return is in the form of dividend. And bear in mind, any payment of dividend cross-border is subject to 10% withholding tax. Any payment of dividend, domestically within Thailand, that could be exempt. Debt funding, there is no thin capitalization rules in Thailand. Therefore, interest deductions is generally allowed as long as it is incurred for the benefits of business. We do need to consider if we make an interest payment outside of Thailand, and that is subject to 15% withholding tax, although that could be reduced under treaty. But any payment of interest between domestic entities, that will be subject to 1% withholding tax. And that's all for Thailand. And, Kwangget, back to you for Q&A.
All right. Thanks, Shuk Peng, John, Anthony, and Jeff. So this brings us to the end of our today's discussion. So we now have some time to respond to some questions from our audience. Okay, so let's look at, for Jeff. Yeah, there's a question for Jeff. What has digital impacted M&A so far? And what impact will it have going forward? Jeff?
Thank you, Kwang. Can you hear me okay?
Yes.
Good, excellent. Just in terms of a very interesting question, and I would answer it in two parts. Kwang. First, and probably most appropriate for everyone on the webcast. It has a pervasive impact. Digitalization and new digital markets are an important and growing part of a wide range of transactions. Both buyers and sellers are keen to explore and consider the digital aspects of the businesses and the deals that they're contemplating. So that's one part, which is pervasive. So that applies to most transactions. Second of all, it is also creating a new segment within M&A markets. And that's particularly round about what we refer to as the digitally native businesses. These entities are getting sufficiently large that they are becoming a force in the wider M&A market. So if you were thinking about the likes of the Grabs, the Gojeks, the Ants, the Tencents, they are all starting to become powerful players. And indeed, some of them, not the names that I've mentioned, but some of them are also becoming targets themselves. So that's a new segment within the M&A markets. In both cases, we're only going to see interest and level of engagement rise over time. Thanks, Juan.
All right, thank you very much, Jeff. All right, there's a question here for John, Indonesia. So, John, in a share deal and the seller is a Singapore tax resident, would there be any relief against the 5% Indonesia transfer tax? John.
Okay, thank you, Kwang. I mentioned about the 5%, and unfortunately, with the current Indonesia-Singapore treaty that is still effective, there is no capital gain provision in that treaty. That's why the position has been that there will be no protection if you were to have the deal happening today. But of course, one thing to observe is that actually Indonesia and Singapore already signed a new treaty early this year. What everyone is waiting for is, of course, when will that treaty become effective, because it's still subject to ratification by the parliament or government of both countries. And interestingly, in the new treaty, if you look at that, actually there will be a capital gain provision, pretty much mirroring what the OECD model. So there might be certain protection applicable if the condition in that treaty actually can be satisfied. Thank you, Kwang.
Thanks, John. We look forward to more developments on that. Okay, I will address one question for Malaysia here. It's asking about more elaboration on the 7-year limit on carry forward of tax losses in Malaysia. Now, this restriction just came about effective from the year of assessment 2019. Yeah. So, for example, losses carry forward as at year of assessment 2018. So this can only be carried forward until year of assessment 2025. Yeah, you count 7 years from there. That would mean that in year of assessment 2026 onwards, these losses will be just gone. Yeah, you can't utilize it. All right, there's one question here for Singapore, Sok Ping. Do tax regulations in Singapore favor asset or share deals?
Right. I think probably the quick answer is it depends, because every deals are different. In general, I think we probably need to look at a few factors. Like, for example, interest on the debt, on the borrowing incurred to purchase accessible income-producing assets may be deductible, whereas interest on the borrowing incurred to purchase the share is not deductible simply because the dividend from which the investment yielded is actually tax exempt in Singapore. So, when the income is not being subject to tax, then likewise, there shouldn't be any deduction allowed on the interest cost itself. So asset due also allow a step up in the basis of tax depreciable asset, including certain self-generated IP rights to their fair market value if structured properly. So purchase of asset involving Singapore real estate would also, trigger higher stamp duty up to 3%. And as compared to share deal, we are talking about only 0.2%. So in short, I think we need to look at what are within the target businesses, the funding arrangement, and the tax risk profile of the target in general to do a quick comparison.
Thanks very much, Sok Peng. I think this is similar for Malaysia as well in terms of deductibility of the financing costs as well as the stamp duty, although the rates in Malaysia are slightly higher than Singapore. All right, we have time only for one last question, and that's for Anthony. So in Thailand, which incentive is more popular, amalgamation or EBT, and why?
Okay, I guess this one. I guess the question is, what kind of industry is more suitable? I guess, and the reason is this. Years ago, EBT used to be a lot more popular because it was actually easier. Amalgamation actually was more difficult, but in the recent year, amalgamation becomes easier. What that means basically is it takes roughly about 1 to 2 months to complete an amalgamation, whereas EBT could take up to about 6 months. But I would say each would have the pro and cons. Amalgamations is generally popular among companies with a lot of licenses, or they have a lot of immovable properties. Due to the nature that there's no cessation of business, there's no transfer. So from a tax cost perspective, it's actually cheaper and it's quicker. The downside of this one is since two entities are actually being dissolved and then combined, amalgamated into new entities, the new entity would be subject to tax audit. So you actually have two companies being audited rather than just one. So each would have the pro and cons.
All right. Thank you, Anthony. I hope that answer your question. So this will wrap up our discussion today. This is unfortunately the time we all have. Thank you, Sok Peng, John, Anthony, and Jeff. And special thanks to all of you who were able to join us. We would like to encourage you to fill out the short survey that will pop up on your screen shortly and tell us what you think about today's program. If you join us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the share this icon and have them visit the debriefs website. We will respond to all the questions submitted during the webcast in a couple of weeks. Also, if you think of any other questions or comments later, please feel free to reach out either to me or our speakers. We'll be more than happy to talk to you. And please don't forget to tune in to our next scheduled webcast from the Indirect Tax series on 3rd December, which is the title Insight into the Australian Taxation Office Approach and Expectations, GST Streamlined Assurance Reviews. So lastly, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax Webcast today. Thank you, have a nice day, and goodbye.